Okay, hello friends. Welcome to the next session of Basics of Accounting. Myself, CA Shruti Sahu, and today we'll be understanding some basic terms of accounting. In the last session, I have told you what is the relevance of accounting. So in this session, now we'll be familiarizing with some technical terms because when you are doing accounting, it's a little technical thing. It's a language wherein you have to know terms and you should be familiar with the terms so that you can understand the language and you can accordingly implement that. So let's begin with the basics of accounting. Let's terms. First is the business transaction. As I've explained earlier also, business transaction is any of the financial transactions. Okay, you have to be very mindful on this, is that we will record only those transactions in terms of money. Okay, so therefore a business transaction, very important, is that it's a financial transaction or any economic event which is enter between the two parties. Okay, which help in initiating or which initiates in accounting. When a transaction happens, then only we'll be doing accounting, right? It's a practical thing. So next thing is that it should be, if you have the characteristic, it's in simple term, it should be in the money. There should be some exchange of goods and services. So there has to be exchange of goods and services. The financial position should change. What do you mean by financial position? Is in terms of, if you have if you're doing a transaction of purchases, so you're purchasing goods. Okay, in turn you are giving cash. So this is what the financial position is changing. You're getting something, and out of that you're giving out one more asset. Okay, now there will, it affects your accounting equation. I told you like how in this example, when we are purchasing and we are giving the cash. So in this there is an equation. Always there is a double entry system, as I explained you previously, which is receiving and which is like receiving and giving. Okay, in this whole definition will be clearing on that. Okay, so next thing is, after each transaction, the total assets of the business must be equal to the liability. So it's quite simple. Asset will be equals to liability plus capital. We'll be analyzing this thing in elaborately when we'll be understanding the accounting equations. Next thing is, we'll be understanding what all accounts. What is the definition? First definition we are understanding is accounts. Accounts is, you have to tell, means it's a when you record a transaction. Okay, it's a record. So accounts is, you always have a head. Okay, head of accounts. Okay, now small accounts are there. See, suppose you are having a transaction with Ram on purchase. Okay, you are having a transaction with Shyam for sales. So these are all what, these are the all accounts. Okay, accounts, because you have to have a transaction with them and you need to record these transactions. Now if you are recording, there may be thousands of purchases you are doing, thousands of vendors. Similarly, you will be selling to multiple customers. Okay, so you have to have a proper books of accounts, so that each person's the money involved, the goods you are purchasing, you are selling, have you got the money, have you not got the money, all those transaction has to be very clear in your accounts. So all of these transactions will be classified under different heads of accounts. Main heads of accounts are assets, liability, income, expense, and capital. Okay, and further, like what I explained you, these Ram, Sham, that is the sale, purchase type of transaction, will be classified under these type of transaction and will be presented under a financial statement completely. So we'll be dealing with this thing in whole of the accounting. We'll be doing that only. So uh, let's try to understand our basic definition. Next definition is capital. Okay, so apart from this, I'll be also want to explain you the nature or of any account. Okay, it's very important for us to understand the nature of accounts. Like I have explained you, there are five type of basic accounts: income, expense, assets, liability, and capital. Now each account have its type of balance. Okay, which I'll be explaining when we say what balance means. Okay, so same way, all these, whatever n number of transactions happens, what you need to keep in mind is, first thing in accounting is, you have to classify these accounts into these five definition. You have to fit in there somewhere. When you fit in these things into those definitions, then the accounting entries, making accounting entries become simple. If you are able to identify, okay, this transaction is income, this transaction is expense, this is related to asset, this is related to liability. Once you do this, then you will be able to do accounting entry very easily. Okay, but if you're not able to classify the transactions into these heads, then it's very difficult, because once you are not able to identify, you won't be understanding the accounting impacts. Okay, because accounting impacts goes with these heads of accounts. Okay, therefore I have taken this separate sessions to understand all the definitions. Okay, once you know what is capital, then okay, if some transaction come, you will classify this as a capital. So now the treatment will be clear, because what capital treatment is, this one is the capital treatment. Now there is one transaction, then you classified, okay, I have purchased asset. So what is the treatment of asset in accounting definition? Then we'll be doing that, right? Okay. So let's move on to the next thing, that is the capital. Now capital is what? Capital is the amount invested. It's in quite simple. Okay, it is very simple. Like any business and businessman is different. Okay, you have this business and entity concepts. Now because of this concept only, if a businessman is giving or investing some amount in business, that is a liability for him. It's not that it's something owns it. Business has to return. Okay, he has to give this money back, as well it has to give profit shares on this money, right? So it's a type of liability, and so it's an amount invested. It's a liability of a business towards the proprietor. Okay, and further, if you earn profit, increases, or it goes add on increasing the liability, and if you are having loss, then it will reduce. Okay, so how does this work is like, if say suppose you have invested 1 lakh rupees. Okay, now you, if you have profit of say suppose 10,000, so this will increase your capital. Understood? Now, let's move on to the next definition. Like as I have told you, investing money is increasing the liability. Similarly, withdrawing money will reduce it, right? So, whenever you are withdrawing, you means businessman is withdrawing the money from business for very important work, is the personal use. Okay, not for any operational purpose. Okay, if you are doing it for, if you're withdrawing money from business for any personal use, then it's called as your drawing. That will be reducing the capital. Okay, so this is the main word is amount withdrawn, or goods also. Goods means if your company is producing some goods and you are withdrawing that good for your personal use, then it will be deducted from your drawings. Okay, let's come to next definition, that is liability. Now, what do you mean by liability? The main word here you have to remember is owed or payable. Okay, liability means any amount which is owed by the business. Okay, now owed by the business means it has to pay to somebody. Okay, Ram owes Shyam means Ram has to pay to Shyam. Okay, so liability towards the owner of the business is termed as internal liability, which we have understood is about capital we are talking about. And in case, say suppose you have purchased some goods from outside. Okay, now you have purchased that good and you have not paid. In that case, that you have to pay that amount to the person external, which is not known as the creditor, we'll be understanding this in detail, which is called as trade payable, and which is the external liability. Okay, so you have to understand when you owe somebody, okay, any in the transaction which gives you a feeling, oh, I have to pay to him, okay, I owe him, then in that case those type of transactions are considered as a liability. Okay, those type of heads. So there can be an internal liability, there can be an external liability too. Now this is about a definition of liability. Now the liability is further divided into two things based on period, on period for which you need to in which you need to pay that. Say suppose in simple terms, first of all let's understand it's simple, then I'll show you a little more technical aspect of that. How to understand this is, say suppose I was explaining you about the liability. Okay, now liability, I have told you whatever amount you owe, okay, or is payable, okay, by whom, businessman, to some external or internal party. It can be both, okay. Now, this liability is further divided into two. What? Current, and one is non-current. Earlier, they used to be called as short term or long term, okay, short term and long term. Now, what do you mean by current and non-current? It say suppose, let's take an example, rupees 1 lakh. You have purchased some goods for 1 lakh and now you need to pay this. Now, the person has told you pay this year 50,000 to me, and next year you pay 50,000 to me. So what happened? Anything. If you are having, this is your reporting period. Say suppose 1st January, to take it as a simple 2003. Here on this point of time you have done this transaction, you have done purchases, you have a liability to pay 1 lakh rupees. Now the liability is such that you have to pay 50,000 within 12 months. Okay, that is the due date for payment is 2024. Next thing, 50,000 you have to pay in next 12 months. Okay. Now what will happen in this? In this scenario, this is current liability. Okay. Current liability in the sense you at this point of time. If you are reporting on 1st January, this is your current liability because you have to pay within 12 months. Okay. Now 12 months is the general idea. Okay, 12 months we are taking. The concept is for operating cycle here. Okay, what do you mean by operating cycle? Now, say suppose this transaction, if this amount has to paid in one operating cycle, then this is called as a current liability. What do you mean by operating cycle? Say suppose you have purchased goods, then you will make a product out of that, then you will do the marketing and sell it, then debtor will pay you, and now you have realized the cash. So this whole cycle of realization of cash, okay, is called as operating cycle, wherein you have invested as in you have purchased the goods, you have processed it, you have manufactured it, and then you have marketed, you have done, and then you have sold, and then you have realized money. Once you realize the money as well, this is whole cycle is called as an operating cycle. So generally operating cycle is consider, if you're not able to identify what's your operating cycle exactly, then it's considered as 12 months. Okay, normal case. In exceptional cases wherein big businesses are big, okay, wherein you will take more time to realize your money, okay, then those type of businesses, it may have operating cycle more than 12 months as well. In general we have it as 12 months. So this is what is called as a current and non-current. Okay, let's move back to our slide wherein I have discussed with you about current liability. I have explained you what is non-current liability with an example. I have explained you what is operating cycle. Okay, so let's go through the definition. Means time between the acquisition of an asset for processing and then conversion into cash. Okay, if the operating cycle cannot be identified, then we will take it as 12 months. Understood? Okay, now this is about liability, we have understood. Now what do you mean by assets? Okay, asset is something you have to be very careful about the definition. There are two, three parameters. First of all, it's a property. Okay, you have to understand that you should be owning that first, and not or. Okay, you should own that, and is controlled by the entity. What do you mean by owned and control? You will say like, oh, if I've owned it, I will control it definitely. No, that's not the case. If you're owning, doesn't means you'll be controlling that also. So you should be owning that and controlling. Also, if say suppose you have purchased some asset and it is not giving you any benefit, okay, then it's not your asset. So what is important, that it enables the firm to get economic benefit. If for example you have purchased some land out of which you're not able to grow, but you have to pay taxes and all the, there is no appreciation in that land, and there is all taxes and other issues coming up, so that type of land is not your asset. Okay, that's why what definition of an asset is, what it's a property. Okay, but it has to be owned and controlled by the entity, and then you should have get a economic benefit out of that. For example, machinery, furnitures, copyright, trademarks. Okay, these are the example of assets. Again, similar way, your assets are divided into current and non-current. Okay, let's discuss about the non-current assets first. Non-current assets are those assets which are held by entity not for the purpose of sale. You have to be very clear on this. See, non-current assets are those assets which you will purchase. Just a simple example you can take is, you have purchased plant and machinery. You have purchased, will you sell it again? No, you have purchased plant and machineries to manufacture, to use it to produce products. So any asset which you are held by entity for not for the purpose of resale, or which are there to facilitate your business operations, then that type of asset is called as a non-current asset. Okay, now non-current fixed asset, like fixed assets are non-current assets of an enterprise which are held for not for sale, but with the purpose to increase the earning capacity. Okay, a simple example is your plant and machinery for that. Now this fixed asset, you have to understand that there are few assets which has a physical existence, like I've been giving you example for plant, machinery, building. So ones which have physical existence, okay, means you can touch them, you can see them, is called as a tangible ones. But those which you cannot touch, okay, those are called as intangible assets. For example, patents, copyright, computer softwares. So these are what, these are all intangible which do not have any physical existence. Okay, so what we have learned till now, we have learned that there are non-current assets which is not for sale but to facilitate the operations of the business, which are held either as investments, okay, for benefit. Now, fixed assets, tangible assets, and intangible assets. We have understood the meaning. Tangible means which have physical existence, intangible means which we do not have a physical existence. But all these are not for resale. These are to facilitate the business. These are for investments. Okay. Second aspect is current. When we say current, is these are in held by the business for the purpose of converting into cash. Okay, in a short period. Okay, very important. Whenever you say current, it's for short period. Okay, you have to understand this, which is when we say short period, and it's more likely to be 12 months. Okay, like you have sold to a customer, now you have to get money from it. So what is it you have sold him and you have given him that you need to pay it in 60 days. The amount need to be paid in 60 days. So this debtor or trade receivable, the receivables that you need to get is to be paid within 60 days. So this is within 12 months, and you will convert this into what? Cash, or you'll get the amount credited in bank. Okay, so this is what, this is therefore called as a current asset which will realize in a shorter and converted into cash or cash equivalent. So this is called as the current assets. Okay. Now prepaid assets. Um, Prepaid expenses. Prepaid expenses are type of current assets only. But what do you mean by it? Say suppose you have a rent. You need to pay rent of 10,000 every month. Now you have paid in advance 6 month rent 60,000 today itself, but you have not taken or availed that services, right? So if you are not availed that services, that means what is happening, you have made a prepaid, you have made it, you have done a expense which is before it you are able to use that service. So in that period, whatever is at that point of time, that is called as, and this is an asset because you will be taking the benefit, you have not yet taken the benefit, so it's not an expense but it's your asset for which you can take future economic benefit. So this is called as a prepaid expense. Now, one thing is that you cannot convert this into cash. Okay, you cannot convert into cash because once you have paid the rent, means you have to avail the services and you intend to avail the service. You don't intend to convert it into cash, unlike other current assets. Now, this is some special term, fictitious asset. Let me tell you, this is not very frequently used nowadays. But I'll explain you what do you mean by fictitious asset is, like say suppose you have been running into losses and you have accumulated a lot of losses. Now these losses, if you hit PNL in that year only, okay, so in that year if you're hitting that, that will impact your PNL. Okay, therefore what is being suggested is that these losses will be accumulated in balance sheet, and then it will be considered as your deferred revenue expenditure like advertisement expenditure, and then it will be divided into the multiple number of years in which you are getting benefit of that expense. A simple example is advertisement expense. For example, you have done advertisement expense, you have made a big ad, okay, you have spent around 1 cr on that. Now what this advertisement expenses means, this type of ads you will be using multiple years, like 2 3 year campaign will go on and you'll be using these ads. So if you'll hit your PNL in 1 year only, then it will give a, in impression in PNL you are getting a lot of expenses, right? So what is proposed here is that you will consider this as a deferred revenue expenditure, means you will defer, means you'll amortize this expense over a period of time as and when you are getting benefit of that advertisement. So this is called as a deferred revenue expenditure, and it's type of a fictitious asset. It's not an actual asset, but we'll consider it as an asset in the balance sheet. Okay, so here we have understood the fictitious assets and all these things. We have also covered uh, current asset. Okay, now current asset I've explained you, anything which we will realize within 12 months, okay, and primarily which are for sale or consumption in the company in the normal operations. Similarly, those which are not current means which are non-current asset. Now which are means which will be those assets which are not current, means of course they are not for sale in the uh, regular course of business. Okay, let's move on to the next definition, which is receipt. In simple term here also, it's like amount you receive, receipt, you are in a receipt of something. Okay, so amount received. Okay, now there are two things which you receive in the course of business. One is revenue and one is capital. Okay, see, one revenue means which in the normal operations we are doing sale. So in this you'll get a revenue receipt. Okay, revenue receipt in the nature of normal course of business or business regular business operations. Okay, so that is called as your revenue receipts. It's related to your normal earning revenue. Okay, that is sale. Then our other definition is capital receipts. Now, capital receipt is something which you have in simple terms, which are not in your normal course of business, but maybe which are due to sale of your plant machinery. Okay, so these are called as a capital receipt, which are not in the revenue in nature. Okay, so like what is the receipt is like you will do sale of machinery, you will sell furniture. You if you have taken any loan, okay, is it related to revenue? Is it due to sale of business you're getting loan? No, I'm getting some money in bank. My bank or cash balance is increasing, but it's not because of my operations, but I have taken some loan. Okay, so these are all critical things that you need to remember. What is revenue receipt? What is a capital receipt? Okay, because these things will help you determine the cash flow from where the money is coming. Okay, which is very relevant. Similarly, there are capital expenditure. Now, what do you mean by capital expenditure? Say, suppose you have done some expenses to purchase plant and machinery. Okay, now this expenditure to acquire any asset, one thing, or second very important thing is improving the existing, which increases the earning capacity. This word is very critical. See, suppose you have an existing plant and machinery and you have done some changes, some repair and maintenance, small thing. Did it increase your earning capacity? No. Okay. Did it increase your production? No. Then it is not a capital expenditure. It's a repair and maintenance, means regular revenue expenditure. But in case you have done some modifications in the plant and machinery which has increased. Earlier you were able to produce thousands units. Now you are able to produce 100 and 500 1500 units out of that. That means you have increased the earning capacity. So this is called as a capital expenditure. So it can be a new, it can be an existing, but increasing the earning capacity of the business. Okay. So this is an example of capital expenditure. And revenue expenditure means which is consumer exhausted within the accounting period. Like you have uh, done some expenses and electricity expenses, you have purchased raw material. So these are all regular related to operations, and it will exhaust, the benefit of which will exhaust in this accounting year only, or called as revenue expenditure, which are treated as an expense. A deferred revenue expenditure, I have explained you in detail also earlier about advertisement expenditure. This is the same thing. Now we'll understand what they mean by revenue. Now you have to understand revenue. When we say word revenue, it's always in the, this is very important, in the ordinary course of activity of the business. Okay. Now there are two type of things you may earn from sale or purchase. You have a purchase, sale and purchase business. You are doing sales of goods and products, and you have sold them, and you're earning. Another source of income which is coming in the name of business, you have purchased one property and you've got a rental income. No, but this is not your regular business, regular normal operation. So what is this? This is your income. It's your other income, but not your revenue. So revenue is a gross inflow. Okay, gross means there may be some more expenses coming in, then it will turn out to give you income. Okay, so it's a gross inflow of cash or receivable arising in the ordinary course of business, like sale of goods, from rendering of services. Okay, and not from other than operations, as explained. Revenue differs from income. As I told you, income may be having different, other income may also be there, but and it is also that income is something when you revenue and you deduct from expense, then you are earning net income. This is your income. Okay. So we have explained you about revenue. What is expense? Expense means the cost incurred. Okay, हमारा खर्चा हुआ है. It's the cost incurred for generating the revenue. Okay, prepaid expense I have explained you earlier also. Now, what is outstanding expense? You will come across these definition a lot. This is much is the outstanding expense. Now, what is outstanding expense? Outstanding expense is something which is payable. Something which payable is your liability, right? So any expenses. Okay, say suppose you have electricity bill. Okay, you have not paid electricity bill for this month, and it is due on next month of 10th. So what is it? That this is outstanding expense. Okay, this is called as an outstanding expense. There's something expense yet to be paid. You have incurred but not yet paid. It's very important term. You have incurred means you have availed the service, you have incurred, you are liable to pay, but you have not been paid. So we'll take the remaining definition in the next session. Thank you for listening. Hope you have understood these definitions well, because I would request you, if you have not understood anything, you can comment and let me know if you have any questions on the topics which we have discussed, so that we can clarify, so that going forward you are clear with the terms and you can apply them well. Okay, thanks for attending and listening. Thank you.